Oh, welcome to Pumping with Bonds Card, the show where we try to pump your portfolio up. And with that, we will start with Europe, especially the girly men in the EMU. But all seriousness, Europe is a mess, and it goes beyond Greece. And we're starting to see that not every economy is really properly pumped up to handle being part of the European currency, the euro currency. And too few policymakers and politicians have been willing to speak up about this. Well, today, the British representative, the minister to the EU Parliament, spoke up today, and we're going to play. We ask everybody to listen to Nigel Farage because he calls both the founders of the Eurozone, the core Eurozone officials, and the Greeks all on the carpet. And he's really right. Having followed the situation since the formation of the Eurozone, as we had to doing international bonds, Mr. Farage actually, states everything correctly. It may not be popular, but just let's take a listen.
Now, Mr. Farage from the FD Group.
Thank you. What we're seeing in this chamber this morning, and indeed across the whole of Europe, is an irreconcilable cultural difference between Greece and Germany, a split between the north and the south of Europe. The European project is actually beginning to die. Nobody in this room will recognise that, but actually the peoples of Europe are saying we were never asked whether we wanted this. This has been foisted upon us. And we need to understand why EMU doesn't work. Those monsters, Kohl and Mitterrand, backed up by the clever but dangerous Delors, believed that if they put in place an economic and monetary union, then as night follows day, there would be political union, that there would be an acceptance of this project, that the north and south of Europe would converge, that we'd all start to love each other, that we'd all begin to feel a European identity, that we'd all begin to show allegiance to the flag and the anthem. Those of us, of course, that criticised this were told that we were extremists and we lacked vision. Well, one vision we didn't lack is we understood that the countries of Europe are different, and that if you try and force together different people or different economies without first seeking the consent of those people, it is unlikely to work. And the plan has failed. This isn't just Greece we're talking about today. The whole of the Mediterranean now finds itself in the wrong currency. And yet virtually nobody in the political arena has got the courage to stand up and say that. Indeed, I feel that the continent is now divided from north to south. There is a new Berlin Wall, and it's called the Euro. And the old enmities have been resumed. Just listen to the way that the German leader of the Christian Democrat group this morning attacked Mr. Spirats. I think it was absolutely disgusting, but it shows the way north and south now feel about each other. Mr. Tsipras, your country should never have joined the euro. I think you've acknowledged that, but the big banks, the big businesses and big politics forced you in. Goldman Sachs, the German arms manufacturers, they were all very happy. And when the bailouts began, they weren't for the Greek people. Those bailouts were to bail out French, German and Italian banks. They haven't helped you at all. And these years of austerity, these years of high unemployment, of increasing poverty, none of it's worked. In fact, your debt GDP ratio has gone from 100% at the start of the crisis to 180% right now. It would be madness, sir, to continue on this course. You have been very brave. You called that referendum when one of your predecessors tried to do the same. The bully boys of Brussels had him removed. They tried their best again. Mr. Juncker said you would have to leave the euro and leave the European Union. Even Mr. Schulz, the president of the parliament, who one would have thought might be neutral, said that if the Greeks voted no, their power supplies may even go down. There were threats and bullying, but the Greeks stood firm. But, sir, you cannot have your cake and eat it. They will give you no more, these people. They can't afford to. If they give you more, they'll have to give other Eurozone members more. So your moment has come. And frankly, if you've got the courage, you should lead the Greek people out of the Eurozone with your head held high. Get back your democracy, get back control of your country, give your people the leadership and the hope that they crave. Yes, it'll be tough for the first few months, but with a devalued currency and with friends of Greece all over the world, you will recover.
In the opinion of Bond Squad and my personal opinion, no truer words have been spoken about the Greek situation and the EMU. Now, readers of Bond Squad reports understand that we have not been supporters of the Greeks. Especially of the, I shouldn't say that. We've not been supporters of the Syriza party. We believe that they indeed want to have their cake and eat it too, as Mr. Farage told Greek Prime Minister Tsipras. It can't be done. All right. We believe that Mr. Farage, who, by the way, his career was before he became a politician, was as a commodities market broker, so he understands finance pretty darn well. We believe that Greece should leave the Eurozone, and we actually agree with Mr. Farage that the Eurozone is or might be an untenable situation. He's right. Early in his speech, he mentioned Mr. Mitterrand and Mr. Kohl. That's Francois Mitterrand of France, who was the Prime Minister of France at the time, and then German Chancellor Helmut Kohl. We remember those names very well because we were trading bonds at the time that those two were in power. And they pretty much tried to ram the euro currency down the throats, just as Mr. Farage said, of the European people and of European politicians. They did try to do a political union via a Euro or EU constitution, and it was soundly defeated, I believe, in every country, but definitely in most countries because it never passed. Having a monetary union without a banking union and political union doesn't work in the long term. At best, you can muddle along with one country pulling along another country, the core, the North pulling along the South, maybe, but it's an extra burden on both. You know, Mr. Farage is right. Southern Europe is in the wrong currency. They need to be in their own currencies, or if you want to keep monetary unions, be in a Southern Eurozone. They're different economies, they're different cultures, and unlike the United States, where people, for the most part, came here voluntarily and willfully accepted political and economic conditions here, that wasn't the case necessarily in the Eurozone. You know, these people did not want to give up their sovereignty, their national cultures, their ways of doing things. So Bond Squad's opinion is that there's a 50-50 chance that the Eurozone breaks up, with at least one member, Greece, leaving, or that we see an untenable situation or inefficient situation where the European economy maybe can grow on average 1.5, which spikes to 2 here and there, but with very low rates necessary to keep that going, and with greater unrest in the South as they become increasingly, not that they're competitive now, but increasingly uncompetitive and fall under the pressure of Germany. Not faulting the Germans for their way of doing things. Our opinion is if the entire monetary union took a more German economic stance, you would have a real powerful economic bloc there. Their model's probably the better model of anybody on the continent, of any country on the continent. But that's probably asking too much of these people to give up their identity. So we do not think that Europe is on the way back to some sort of grand recovery, pulling up the rest of the world. You know, we don't see the global economy picking up steam. In fact, we see the global economy possibly slowing. And we don't think that there's a happy ending in the Eurozone, just maybe a less sad one. we don't see how it's tenable. Now you have the UK considering, they're talking about this, leaving the European Union. Remember, they're not members of the EMU, the euro currency, but they are. But the UK is a member of the EU. We don't see how it works. Please, except for hope, somebody tell us how and why it works, and don't say because it has to, because the alternative is too bad. Well, sorry, that's still hope. It's not strategy. We don't see how it works unless there's political and banking union over there, and that's becoming less and less likely each day. We're starting to see the Podemos party gain popularity in Spain, even though Spain has seen its economy pick up over the past year as they've instituted some private sector reforms. We see the infamous Beppe Grillo, we love that name, by the way, in Italy, gain popularity. He favors exiting the Eurozone, and he prefers rolling back reforms, and he's starting to get some traction with the Italian electorate. We don't begrudge anyone for wanting to live the way they want to live. They're willing to accept the consequences as well as the benefits of it. More power to them. But they're trapped. And from our standpoint, we believe that a fractured Europe might be a healthier Europe, and a shotgun wedding Europe, it will just be the sick man of the developed world economic-wise. So that's what we think. Now, as bad as Europe is, China appears to be worse. Now, China continues to be the darling of the financial media, of portfolio strategists, and they keep coming back to, but China's population is so big and that's so far to go. All right, population while it's helpful to have a large population, you want a large economy, isn't necessarily the end-all and be-all. For instance, Japan has a population a fraction of the size of China, but has an economy that's nearly the same size. Russia has a huge population, and its economy can't get into gear, never mind out of first gear. India has a larger population than any country except for China, and they're not growing gangbusters. There's some improvement here and there. So, and then you look at Germany, has a relatively small population compared to other economies in and around its size. So it's not just population that matters. It's the system of government, it's economic policies, it's rule of law, it's the desire of the people. And right now, the desire of the people is that they fall into the trap of moral hazard, and we believe investors across the world have also fallen into the trap of moral hazard, and that they think the Chinese government can and will bail them out. That is not always the case, and look what's happening. The Chinese government is desperately trying to prop up equity prices. But what happened was equity prices disconnected, they decoupled from economic reality. Now, defenders of the Chinese story say, well, since it's decoupled from economic reality anyway, a correction in that market doesn't necessarily mean a downturn in the economy. And if you look at it in a narrow range, there's some truth to that. But when you consider this, about 25% of the money that's in Chinese equities has come into the market in the last 2 months. Most of the Chinese money that's come into that market in the past 2 months have been from retail investors who borrowed to buy stocks. They leveraged themselves several times over. Okay? So their exposure is huge, and they bought at or near the top of the market. So some of these people are down 25 to 30%. So you can't say, oh, but look, it's still up 60% from 40% from last year. You can't say that, and that everything's okay. Yeah, if you bought from last July through early March, you're probably okay. You're doing well if you bought last year. You're doing okay if you bought early this year. But for the people that came in to the market in May, let's say from the end of April to about mid-June, early June, you got your heads handed to them, and they're leveraged. So just as any gains would have been magnified because of leverage, the losses are magnified because of leverage too. It's wiping people out, much like 1929 U.S. Okay? Now, this is the consumer class that's getting hit. So while it might not cause a recession, not that we would ever really know in China, right? It could slow economic growth, especially if they're trying to become more consumption-driven, less export-driven. So now the fear is that China will roll back economic reforms and try to become more export-driven, more outward-looking again, and at least temporarily abandon the move to a consumer-driven economy simply because the consumers can't drive it. It's funny how China, has fallen from its lofty levels. It was only a few years ago it was growing at 10% GDP, then 8, now 7 for Q1 of this year, and the Q2 Street Consensus estimate is 6.8. Almost every strategist and economist we've communicated with believes that 7% and even a 6.8% read would be inflated above what's real. What we've heard mostly is that it's 50 to 100 basis points lower than what the official number is. One strategist, fixed income strategist, whose specialty is foreign markets, foreign economies, told us that she believes that China GDP is already below 6%. Now, the argument is always hold out, yeah, but look at the U.S., maybe we'll grow 2.5%. That's, by the way, the last Atlanta Fed GDP now estimate as of yesterday. We would kill to have even 6%. Time out. We are a developed economy. They are an emerging economy, right? And more importantly, the markets, especially asset and commodities prices, and you'll see commodities prices getting killed now, we're pricing in stronger GDP. They were hoping that we'd see a surprise above the government's forecast, or as they said, our desire. Yeah, it became the desire when they couldn't fight it, of 7%. Now we're threatening to undershoot that. So now we have markets and economic strategies, investment strategies, asset prices that were priced to 7% plus Chinese growth and pulling up Asia, which would pull up the world, and now you're probably not going to get that. So where's this improving global growth coming from? It probably is not coming. China, as we said before, is a house of cards. Ruchir Sharma from Morgan Stanley wrote an excellent editorial in today's Wall Street Journal. We should just everybody reading that. He hits the nail on the head. The whole thing was on a Beijing put that China would never let things go down. They would prop things up. That's not a strategy. That's hope. Okay, that's not an investment strategy. We do not feel sorry for anyone who invested in China under the premise that it's a good deal because the Chinese government won't let things fail. Good luck. Okay, sometimes things get so out of hand, governments can't do it. And quite frankly, we'd rather invest where the government has less influence, because the government tends to, no matter where it is, tries to pick winners and losers for the good of the economy. That's not always the case, right? So we would stay away from China still. Why? Do you want to bet? Go bet. Go do China a favor. Go to Macau. Go to the casino. At least you'll have a good time betting in China, right? Do something like that. But we don't see it. And now we had the release of the Fed minutes today, and what is it? The Fed is concerned about China, and this is 3 weeks ago these minutes were taken, and they were concerned that there wouldn't be a Greek deal. Well, now we have to concede that there's probably no better than a 50% chance that we see a rate hike liftoff in September. In fact, there might not be a better than 50% chance that we see a rate hike at all in 2015. don't worry, the Fed's not under any pressure. We have job growth that kind of took a step down, downshifted a gear. We saw wage growth step back into a lower gear. We saw labor force participation run at the lowest number since 1977. So it looks like that spring rebound, if you want to call it that, it really went back to trend. Might be fading here. We might be settling back into a flat 2% type of economy later on this year, not this roaring 3%. Why do people keep saying? Why do economists keep saying it's going to 3? It's got to, because it has in the past, and the models show it should. Yet every survey of consumers, especially younger consumers, show a shift in priorities and tastes, a change in incomes and obligations. Demographics have been changing. Technology's been changing. Let's look at Apple. Apple's no longer an aggressive tech company that, it's a staple. It's an industrial, inelastic demand staple, almost as much as Johnson & Johnson and Procter & Gamble are. That's how much things have changed. Netflix is no longer this, this ground floor geeky tech opportunity that you can make earn multiples of your original investment. It's becoming another standard everyday media source. Okay, things that used to be aggressive and quirky and have potential to grow exponentially are now becoming everyday staples with fairly inelastic demand curves. Conversely, things that used to have inelastic demand curves, homes and whatnot, have elastic demand curves. I'll buy it if the price is right, if my income is better, they'll do it, but it's not a necessity the way it was before. We'll rent, we'll lease, we'll share, we'll stay at home till we're 35, like some millennials are. Whatever the case may be, there's been a change in the economy. There's been a change in demographics. There's been a change in priorities. And, that has to be acknowledged. We're seeing population go negative in Europe. It's shrinking in China, although it's a big country, and it still has theoretically a long way to go to develop if it wants to develop beyond a certain point. It's always assumed that every country wants to be like the U.S. So we don't see that, and this lack of demand, relatively speaking, or the smaller demand for commodities, is pulling down commodity prices, which is in turn pulling down inflation. All right, and that's pulling down long-term rates. Remember, long-term rates price to inflation expectations. We've said this over and over and over again, and still people, our own readers will point out, yeah, but this portfolio strategist publication we got for our firm says, that growth is going to be better, so with higher rates, and we should all buy tips. No. Long-term rates price to inflation expectations, and as we've seen the European situation, the Chinese situation, and even to a lesser extent the U.S. situation deteriorate, although more so Greece and China. We've seen the dollar strengthen again, albeit modestly, but we've seen commodity prices crash. Oil prices are at the lowest level in months. Iron ore dropped to about 16% in the last week, killing some of the bonds we had exposure in. We bought some of the, in some portfolios, some what we thought were good commodities bonds, bonds issued by commodity companies, but try to buy the best in the beaten up sector, and the sector got beaten up even worse. China's even worse than we thought it was, and we thought it was a house of cards. It happens. But that's pulling down inflation, and that's pulling down bond yields. Yeah, if you have some sort of resolution in Greece, you might get a pop-up. I mean, the 10-year Treasury ended today at around 219 or so, almost just under 220. Maybe you get a resolution in Greece that pops to 230. Maybe if China stabilizes, we get a pop to 240 again. That's where we think we end the year, 240. I just flipped over to my Bloomberg, and we have overnight trading in Treasury just started, and we just bouncing between 219 and 217 as we speak. I mean, that's where it is. There's not this upward pressure. I mean, 3%, maybe next year. We doubt the Fed wants to see that. And remember, the Fed tightens, what happens? Flattens the curve. Also starts to pull down on long-term rates. So we don't see long-term rates blowing out. Commodities can be volatile, so some people try to kind of push that aside as far as being a good indicator. Say, oh, there's speculators and there's short sellers going in commodities. But commodity-related bonds, bonds issued by commodity producing companies, can be a good bellwether as to the true outlook for commodities, because the bond market tends to be very fundamentally driven on. Speculation exists, but not like it does in the futures or equity market. So what we've noticed is that for the last month and a half, let's call it, we've seen the credit spreads between even investment grade metals producers and U.S. Treasuries widen out. And in the last week, the spreads haven't just widened out with just either Treasury yields going down or commodity bond prices going up. They've really started to diverge. Sometimes you get widening where all rates go up, but the corporate bond rate goes up even more. But here we're seeing a divergence in the air. So the bond market is telling you that, you know what, not this year, no 3% Treasury this year, maybe not a Fed funds rate hike this year. And we believe that we're later in the business/economic cycle than many economists believe. We're not in the 5th or 6th inning. We're probably 7th inning stretch or 8th inning at this point. And the Fed usually comes in and tightens in like the 2nd, maybe 3rd inning if it's late. Now it has to tighten when the game is almost over. So it's going to tighten, and then probably not too far after, and without rates going up too much on the short end, it's going to have to come in and ease. So, maybe we get to a 2% Fed funds rate by 17, late 17, early 18, maybe. Look, our base case for the Fed funds rate at the end of 16 was about 1%, and when we made that call at the beginning of this year or late last year, it was right around the holidays, I believe. We had people, including one fixed income strategist, say, "Wow, you're aggressive at Bond Squad." But slowly but surely, it's coming to us. We don't see it. We stop looking at models. Look at the world. Look at reality. Don't look at the theoretical. Let's look at what's really happening. You don't have much inflation pressures, and nor do you have much of a way to generate them other than devaluing a currency. And how in the world can the U.S. generate inflation by devaluing when, one, it's rolling back accommodation, or wants to, and the rest of the world is pouring it in? Now, we read a mid-year report by Wells Fargo, and we agreed with Wells as far as where value lies in the fixed income market, mainly municipals, which is they're stupid attractive for those, especially for those who are in a high tax bracket, and we're suitable. But they're seeing all these green shoots all over the world, better growth, and they're investing. They're suggesting this because monetary policy is going to be very accommodative, and it has to come. No, it doesn't have to. This reminds us back in the years leading up to the financial crisis and the blow up of the automakers. When we were at Citi, our auto industry strategists kept recommending the auto company bonds and the auto finance bonds, not because they're fixing their business model, not because we expected greater profitability or increased sales or fewer rebates to increase margins on vehicles. You know what the reason was? Because they have plenty of liquidity. In other words, the bonds should be good because they can keep borrowing to pay off the bonds you're buying. That worked until it didn't. All right? So when you're investing because a company has great liquidity or because a country is putting all the stimulus in, you're assuming that it works, and it doesn't always work. Okay? It's how you use that liquidity if you're a company, how you use that stimulus if you're an economy. And it's not a foregone conclusion that it works. So what we're doing, we have portfolios kind of barbell, not vacating the belly of the curve, but we're weighting the ends, 2s and 12, 2 and 15, some 20 years out in municipals where suitable. We are most of our junk exposure, with some rare exceptions, is in the double B area. We believe double B in high yield for aggressive investors, triple B to some low single A for moderate investors makes sense. Municipals, even on an after-tax basis for some investors, makes sense. For the investors not in the highest tax bracket. That's where we think we are. The stock market is trading sideways. We see this as a small gain year, if that. We're late in the cycle, and history doesn't have to repeat itself; it just has to rhyme, and we rhymed, especially with equity prices. So, don't mean to sound dour. We don't think that China or Europe pulls us into a recession. Well, it could shave half a point off our growth, maybe a full point. It's possible. So you're growing at 2.5, maybe you're 2 or 1.5. If you're supposed to grow at 3, maybe at 2.5 or 2. And that's kind of what's been happening. So, so far the only thing people can come back to us with, well, the model says different, and the model's been wrong for 5 years as far as what's supposed to happen. So, with that, we just want to give our disclaimers. We didn't do it at the beginning. I know one of our partners, Kevin, will probably be upset with us here, but compliance probably won't, because we're going to give the disclaimers anyway. Bond Squad, as always, is brought to you by Wealth Strategies and Management, 907 Main Street, Strasburg, Pennsylvania. WSM LLC and Bond Squad are separate entities from PAG, Private Advisor Group, which is a registered investment advisor and our registered investment advisor. And thanks to Private Advisor Group, Bond Squad is able to manage portfolios on a separately managed account basis. We're gaining traction in that. That was not supposed to be one of our core endeavors when we first started out, but some of our readers requested us. Some firms have been gracious enough to allow us to manage money at their firm. We thank them for that. Particularly, I'd like to thank Morgan Stanley. They've been very, very helpful in coordinating our managing of assets at their firm. We've been treated very well, and a shout out to their consulting group desk. When we have to execute on the street, they've provided us with some of the best levels we've seen around. That's our experience. We're not necessarily endorsing them. We're just stating our experience there. Great bunch of guys over there. And with that, that's all we have for tonight. Keep on reading. Ask us questions. Call me, market hours, 570-424-1555. Email me, thomas.byrne, that's B-Y-R-N-E, at WSandM, that's Whiskey Sierra, the word and, Mike.com. And we'll get back to you. And just hang in there. The only people getting hammered are those who are overexposed and, well, believe the correlation models without, looking out the window to see if it's raining. We'll all get through this together. Worse things have happened. Just stay the course, stay with us, and you'll be fine. And we'll leave you with the tune that hopefully resounds with you all. We want to congratulate the Grateful Dead. They just played their last concert, the Fairly Well concerts, and so we'll end with our favorite Grateful Dead song. Thank you and good night.
Look out of any window, any morning, any evening, any day. Maybe the sun is shining, birds are winging, rain is falling from a heavy sky. What do you want me to do for you? The secret